What's up YouTube? Dougie Chong here. Welcome to today's episode where I'll be talking about one of my least favorite financial instruments known as mutual funds. Just a quick disclaimer, I am not a financial expert. This is not legal financial advice. Also, I do not own any mutual funds, so this video is largely based on research I have done. So what exactly is a mutual fund? Well, a mutual fund is a group of stocks or equities, could be bonds, that a bank or other company puts together so that you, the investor, can purchase a part of it. Now, if you watched my video on index funds, which I'll try to link somewhere or leave in the description below, you'll realize that this sounds a lot similar to an index fund. The key distinction between mutual funds and index funds are that mutual funds are actively managed. So there's a manager that actively picks which stocks go in and out of that mutual fund. An index fund tries to track an index based on some sort of algorithm. So there's not as much of an active component to managing an index fund. It is this active managing that makes mutual funds cost so much, and they'll have a MER, which stands for Management Expense Ratio, of upwards of 2%, which is a lot higher than most index funds. A quick example of how MERs work is if you put $100 into a mutual fund with a 2% MER, you would have to pay $2 in that first year just for them to manage your account. Each subsequent year you still have that mutual fund, you would pay an additional 2%. It is this high MER that makes me dislike most mutual funds and leads me to not recommend them most of the time. Now, don't get me wrong, some mutual funds can greatly outperform most other assets, but that is very rare to see. This MER essentially pays the mutual fund manager's entire team's salary, whether the mutual fund goes up or down. A large part of a bank's revenue will come from the sales of these mutual funds, so it is in their best interest to sell these. And they'll note upwards of 7 or 9% returns on these mutual funds to make the 2% seem negligible. However, I will show in a chart that this 2% fee will really add up over time. Other differences of mutual funds include that you can't trade them intraday and that there are minimum buy-ins for a lot of mutual funds. Now I will show an example of a mutual fund that has done well in the past that tries to track large tech companies in the US. I chose this mutual fund because it has done well in the past, and I greatly believe in large tech companies such as Amazon and Facebook. I will also compare it against an ETF, which stands for Exchange Traded Fund, that also tracks large tech companies, but with a much lower MER. So here is the mutual fund I decided to take a look at. It is called the TD US Blue Chip Equity Fund. Its fund code is TDB977, and it currently trades at a price of $53.92. As you can see, it has an MER of 2.38%, which is fairly average for an MER. Here are some of the key statistics of this fund. As you can see, there are a lot of assets in this fund, about $5 billion worth of assets. Now, looking at the top holdings for this mutual fund, you can see most of the stocks are tech stocks, such as Amazon, Microsoft, Facebook, and Google. Therefore, I decided to compare it against a technology stock ETF known as VGT. As you can see from the holdings here, it has a lot of similar tech companies in its portfolio, such as Microsoft, Visa, and MasterCard. It's interesting to note that this portfolio holds Apple stock, whereas the mutual fund portfolio held Amazon stock. Looking at the expense ratio for this ETF, it is a mere 0.1%. That means it's only charging 0.1% of your holdings to manage this fund. That is a much lower rate compared to the 2.38% that the mutual fund by TD was showing. Here is a chart showing the VGT ETF in purple compared to the TD mutual fund shown in green over a 5-year time period. As you can see, the VGT ETF goes to around 72% total returns, whereas the mutual fund is just a bit under 60%. As you can see from the trend lines, they mirror each other fairly closely since they are invested in closely the same stocks. However, it is the additional 2% MER that really sets it apart. This is why I typically recommend going with the ETF as opposed to the mutual fund, unless you think the mutual fund advisor's expertise is able to compensate for the difference. That's it for this video, guys. Thanks a lot for watching. Hope you learned a lot about mutual funds. Let me know what you think about them in the comments below. Also, please leave a like if this video helped you at all, or subscribe if you have not already. Thanks a lot for watching. Till next time.